Hello, everybody. Chuck Carnevale, co-founder, FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation, bringing you another 2-minute drill subscriber request series, Lessons in Valuation. And today's video has some really interesting lessons in valuation. And it's a real estate investment trust, a healthcare REIT. So let's go ahead and get into the FastGraphs and look at what we have today. The company is Alexandria Real Estate Equities. And again, it's a healthcare REIT. It's interesting with FastGraphs, you can go in the external links here and go into the company's website, and you can learn some things about the companies and what they do and how they operate. And in Alexandra's case, they've got some information on themselves. But here's what I wanted to note about this stock. The growth rate has been 2.66% going back to the life of this graph, which is 2007. But if I shorten this to about a 15-year graph, now the growth rate is a little more attractive at 4.38%, but it still doesn't have very high growth. But for some reason, by looking at the blue line here, the average trimmed average PE ratio over this time frame that the market has applied has been almost 23 times price to AFFO. This is adjusted funds from operations. This is different than earnings. But look how they've highly valued this stock. And they've highly valued it for years. But even had you bought it back here at these high valuations and all of a sudden held it to today when it finally came into reasonable territory, you'd have lost money owning this stock for several years. Now, it does offer a very nice dividend yield, almost 7%, because the stock is trading at a very attractive valuation, especially when you consider the market has always valued it very richly. From a forecasting point of view, it's not expected to grow less than 2% a year. Putting a 12 multiple times AFFO would give you a 15% rate of return. If it traded more along that 15 or 16% multiple, it would give you a little higher rate of return, up to 25% a year. So it could be very interesting today. But the point is, here's a stock or a REIT that the market has always highly valued and overvalued, and then we've all of a sudden had this correction with not a whole lot going wrong with the company. Actually, earnings growth was strong during this time frame, but healthcare REITs got a little out of favor, I guess, and this stock has now fallen to extremely low valuation relative to its historical norms. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, bringing you another subscriber request series. I don't know a lot about this REIT, but it could be intriguing to look into now given its current valuation. Thanks for watching. Ring the bell if you haven't. Give me a like and subscribe to our channel if you're not already a subscriber. And look at subscribing to FastGraphs. When you're looking at real estate investment trust, note that it automatically moved to funds from operations as the metric rather than earnings. Thanks for watching.